Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John. How are you doing?
I'm doing very well. Although the dog days of August are now upon us, I hope you're doing well.
Yeah, I mean, you're definitely right on that one. We're kind of getting revenge for the cooler weeks we've had previously.
Well, you're right. It's absolutely hot as blazes outside. And Sam, do you know what else is hot as blazes?
What's that?
The Federal Reserve's balance sheet.
So exciting.
Isn't that corny? Dad joke. In any event, as everyone that listens to economic podcasts or reads economic newsletters probably knows, the Federal Reserve has dramatically increased the number of debt holdings that it owns, really since the financial system crisis of 2007, 8, and 2009. And Sam, it's just unbelievable. And they continue to go up by how much each month?
Over $100 billion a month.
Around $120 billion of new debt securities, all of them government-related, whether or not they be direct obligations of the U.S. Treasury or Fannie Mae or Ginnie Mae or Freddie Mac or something along those lines.
All government-sponsored, government-backed AAA stuff.
And so, Sam, I actually did a little back-of-the-envelope sort of calculations, and I did it because, I was at a conference on Monday and Tuesday of this week out of state, and I was scheduled to speak on the economy, and I did. And someone asked me just how much longer can this liquidity-fueled nonsense, and that's what the word that they use, nonsense, how much longer can it last? And I said, well, I think it can last for a little while longer yet, but so much depends on just how long the Federal Reserve wants to continue to add to its balance sheet and therefore, in a lot of ways, artificially depress the price of money in the U.S. economy. Sam, your thoughts?
It's one of those things that's hard to kind of unravel, and it's hard to work your way out of a situation once you start it.
Well, it certainly is, because when you take a look at the Fed's balance sheet, which I know everyone does, Sam, you go to a party
every day, right?
You go to a party, sit around talking about football, maybe golf a little bit. I don't know what you did at the rodeo when you were at Auburn University, all that stuff. You're talking about good times. It's
natural to bring up the Fed's balance sheet next.
Invariably it comes up. And at the end of 2007, if I'm not mistaken, Sam, you might know a little bit better than I, but the Federal Reserve owned about $750 billion worth of U.S. Treasury securities on its balance sheet. That was about 17% of the total outstanding.
There's a lot.
That's a lot of money. What do you think that number is now, Big Sam?
A couple dollars more at least.
A couple of dollars more. Fast forward into the future, and good night, the Fed's balance sheet has grown to over $8 trillion as we speak. It's actually about $8.3 trillion, and if I'm not mistaken, about $6 trillion of that is actually in brand new, spanking new U.S. Treasury direct obligations. So as a result, you take a look at the Fed now owns a significantly higher portion of Treasury debt in both absolute and relative terms, because the Treasury debt has grown to $22 trillion, and now the Fed owns about over $7 trillion worth of it.
So if the Federal Reserve is buying all this brand new debt, it kind of reminds me of a topic we talked about previously. And
what's that?
Got a lot of people upset, and that was modern monetary theory.
Modern monetary theory? Sam, come on, you can't be serious. In the meantime, you know who else has been gobbling up U.S. Treasury debt?
A lot of foreigners.
A lot of foreigners, which for the never-Trumpers and all that stuff, actually not the never-Trumpers. Maybe we're just leave it at that. Just not go down that slippery slope. But foreign investors at the end of 2007 owned about $2.3 trillion worth of publicly traded U.S. Treasury debt. Sam, that's about 40% or 50% actually of the total back then and there. Now it owns about $7.2 trillion, and it's only about 33% of it. But even so, you take a look at all of it in both in absolute and relative terms. Foreign investors and the U.S. Federal Reserve owns about 70% of all tradable U.S. Treasury securities out there, since most types of debt instruments and interest rates are, if not directly, indirectly set by the U.S. Treasury market. How goes Treasury yields is how goes the price of money in the U.S. economy, and foreigners and our own central bank, for all intents and purposes, Sam, are setting the price of money in our economy.
And probably not even just our economy. It's really kind of globally. I mean, the U.S. Treasury, like you said, I mean, that is kind of the basis for everything. You add on yield for risk, you add on yield for whatever have you, duration, but it's all kind of goes back to what's the U.S. Treasury equivalent of it. And it makes sense why foreign countries would be coming in and buying our debt right now, because guess what? Most of their countries are kind of in the same boat, except our debt's probably a little more safe than theirs is.
If not safe, certainly liquid.
Yeah.
Certainly far more liquid. And Sam, really, over the years, the Federal Reserve, its balance sheet as a percentage of the U.S. economy has mushroomed as well, going from an historical average roughly 5 to 6% for decades to about 37.2%, at least as of the end of the second quarter. But Sam, you kind of sparked my interest or piqued my interest or a little bit of what have you with something that you said about modern monetary theory and whether or not this is what the Federal Reserve is doing, either consciously or unconsciously, with their explosion in the balance sheet. Please explain what you mean.
Well, that's what's happening. You said most of it is new debt.
Yeah.
So if the Federal Reserve is going out and buying new debt, they're basically servicing and funding the U.S. government's constant deficit that we have.
So, Sam, what you're kind of saying is the U.S. government is self-financing.
Yeah, I mean, that's the beauty of being the world's reserve currency, too, I guess.
So how is this really any different, Sam, than paying off one credit card with another credit card?
It's not really. It's just kind of moving it around on the balance sheet.
Sam, this sounds like fraud.
No, it's called being the reserve currency. It's the same thing.
So maybe we should steer away from saying this is all fraud and a scam. But in all seriousness, and talking about the U.S. economy and how much longer it can continue to grow, I think we're, about 6.5% annualized over the last several quarters, couple quarters?
Something like that.
What the estimates are for 5 to 6, depending on which outlets you like to consume, 6, 5, 6, 7%, some even a little bit higher than that. How much longer can we have these outside sort of predictions for economic growth? And I said probably really up into the middle of next year. I think our crystal ball is pretty clear up until then. And then it gets a little bit more foggy. And I told the group that I was speaking to down in Florida that the huge chunk of it is because, again, the Federal Reserve has been really impacting the price of money in the U.S. economy. And what happens when it starts tapering its monthly purchases, going from $120 billion to $100 billion, maybe even ultimately getting down to no money, no additional purchases each month. And what happens if all of a sudden that spigot or that backstop, whatever you want to say, that end user, that final demand of around $1.4 trillion is no longer there, then that debt has to be purchased by someone, because Washington's going to continue to spend money. And oh, by the way, I'm not sure if you knew this, but the House just passed something like $3.5 trillion. And so all this money has to come from somewhere. Now who gobbles it up if the Federal Reserve starts sitting on the sideline?
Well, I think that's one of the big questions, is how much demand is there outside of the Federal Reserve? And I think it's kind of a tricky question. I mean, there's been times before where we did have essentially kind of what we're doing now, where the Federal Reserve was going out and buying assets and rates kind of rose a little. And, the impact that it has on the economy is pretty strong, and it's pretty significant. What happens when the Federal Reserve essentially floods the market with all this cash? And so it's kind of a two-way street, and you have to look at what's more important, the amount of purchases that they're doing or the impact that it's having on the economy.
Well, I think you and I have talked about this, and I'm not sure we're in lockstep on this, and particularly in terms of price of money. And my longer-term conviction is that Fed backstop, or those Fed built-in purchases, ultimately have driven the yields down because of just there's someone out there buying it. And so it's just simple supply and demand. And the thought process is, if and when the Fed starts tapering, economic activity could or should slow down, so yields would fall in that regard.
Yeah.
However, what if I take sort of a counterintuitive position saying, well, ordinarily that would be the case, but since the Fed has been really the primary buyer of new debt issuance from the U.S. Treasury over the last decade, particularly over the last couple of years, if all of a sudden that purchaser is gone, again, someone has to buy it. And Sam, I'm going to ask you this. All right, do you have a huge appetite for 2-year Treasury securities yielding 25 basis points?
The only way I would is if I was a German and my options were that or buying the Bund at negative 80 basis points.
Sam, I'm going to ask you another question. What kind of appetite do you have to buy 10-year U.S. Treasury securities with a yield of 1.25%?
Again, as an American, zilch.
Okay, one last final question. What is your demand as a U.S. investor for 30-year, long-term U.S. Treasury debt with a yield of 1.25%? 9%, understanding, Sam, that currently the CPI is running at, 5.4%, and that even according to the TIPS market, 30-year inflation expectations hover between 2.2 and 2.3%. So your money right there, Sam, is already underwater if you buy now. Sam, what is your appetite for this?
I'm just jealous that I can't have debt at that rate.
And so that's why I'm thinking that I hear the arguments about, hey, the Fed's not in there pumping all this liquidity. More liquidity is better than less liquidity in terms of generating economic activity, all of that. However, the yields are so ridiculous. It's been such a major purchaser of it that I'm not sure you can get the average American, even if the economy were to slow down somewhat, to feel comfortable or thrilled or excited or what have you, desirous of purchasing long-term U.S. debt securities at yields that are comfortably lower than, one, the historical rate of inflation, and then two, the expected rate of inflation moving forward. Sam, your thoughts?
No, it's not starting to. For a while, it kind of hasn't made sense. And you mentioned it with the CPI numbers. And, we've talked about inflation kind of being transitory, but even when you go back to that historical average of what inflation is, who wants to lock their money in for these rates in that amount of time that it takes? And essentially nobody. I mean, the only people who would want to do this are people their hands are almost forced into it, whether it's a bank, whether it's a insurance company, a foreign government, and they need certain duration and certain amount of debt. It doesn't make sense why anyone would want that here. And I think that is what's different possibly now than previous times where we've had quantitative easing and pulled back on it, is just the sheer amount and the relative percentage of the debt that the Federal Reserve is taking on versus foreign governments.
Well, you're right. And then you used the phrase with their hands tied. How close is the Federal Reserve getting to a point where its hands are tied and it cannot significantly reduce the amount of debt that it's putting on its balance sheet?
I think we've been there. I think it's become a new norm, and I think it's become a new norm just in the sense of, stimulus checks. It's the same thing. Once you kind of open the floodgates and people expect this complete backstop of anything going wrong in the market, it's really hard for people to undo that. It's what people come to expect. It's what the market comes to expect. And I think you're even seeing people, calling the Fed's bluff, if it turns out to be a bluff, on that, how quickly and aggressively they're going to taper and hike rates. There's going to be something else that probably comes at some point, and whether it's the Lambda variant or the Gamma or whatever comes after that. But, COVID's probably not going away, and whether it's COVID or something else, there's always going to be an easier and easier excuse to keep policy pretty loose.
Well, you suggested that maybe the Gamma variant would come after the Delta variant. Sam, back when I was in college, I had to learn the Greek alphabet for an organization which I was a member of, and if I remember correctly, it goes Alpha, Beta, Gamma, Delta.
Well, they skipped Gamma, didn't they? Maybe not. Maybe that just wasn't a good one.
I have no idea, and I don't know how I pulled that one out. But
we'll have the Zeta variant at some point.
Well, for all of our listeners in the UK, that'd be the Z, I think. But in thinking about truly what the Federal Reserve has done and how it's potentially boxed itself into a corner, I mean, we really are getting to a position with the level of debt, both in absolute and relative terms, absolute and just sheer trillions, and relative compared to the size of our economy, that it could be a real problem if interest rates backed up too suddenly, too quick, at least in our ability to service our debt, one, and then provide meaningful services with the amount of debt that we have available out there. So higher interest rates right now would be a real trouble for the United States Treasury, truthfully. So I think there's going to be political pressure on the Federal Reserve. It doesn't matter if it makes fiscal sense or not, or monetary policy sense. I think whoever is the chairman of the Federal Reserve is going to get significant political pressure from the powers that be, whether it be Democrat or Republican, it doesn't matter who's at 1600, to be very judicious in tapering or cutting off or draining reserves out of the system.
Well, that's because that's who it's looked upon. That's whose fault people view it as. If the economy starts to slow because the Federal Reserve hiked rates, well, guess what? A lot of people are going to look at that as what the Biden administration is doing right now. And it's we're at a kind of confusing point or tricky point in the sense that, if they're going to let rates rise, and if that's kind of the opinion that people are thinking, that means it's going to cost a lot more to start servicing our debt. Right now the cost to service our debt is not, and percentage of GDP is not that extreme right now, and most of that is due to just the obnoxiously low rates that you were talking about.
That's right.
And so if we're going to start to peel back the QE and that does start to raise rates, well, guess what? That's going to start to spike pretty significantly and pretty quickly, especially with the continued spending that we're seeing.
So, all right, now we're coming up against time, at least a little bit here today on Trading Perspectives. So, Sam, I'm going to ask you a question or two.
Okay.
One, was the Federal Reserve correct in its assessment last year to dump as much money on their balance sheet, to provide as much liquidity as it did to mitigate the downturns from the pandemic?
Yes.
Okay, that's the first question. I think I might agree with you on that. Second one is, should they continue to add as much money as they are onto the balance sheet at this given time, $120 billion or thereabouts, understanding that the economy has been growing at a 6.5% clip for the last couple of quarters? We have all this fiscal stimulus that's out there, and understanding that the banking system is truly awash in excess reserves, and the loan to deposit ratio is hovering around 60%, meaning that there's a ton of cash floating out there. Is it necessary for the Fed to continue to do this at this time?
It depends who's asking. I think if you're someone in the stock market, you definitely want the Federal Reserve
or the real estate market or what have you. Yeah,
but no, I don't think there's much justification for the continuation of $120 billion a month. And without getting too nerdy, I mean, the Fed's reverse repo facility that they have, there's over $1 trillion in that right now, and that's essentially money that these banks need to get off their books. It's essentially cash or cash equivalents that they need to get off their books overnight. And there's over $1 trillion sitting there right now. There's over $1 trillion of cash that banks cannot have on their balance sheet right now, and that's a lot. That's well more than it has ever been.
It's a ton of money, and I'm going to use a very bad analogy and kind of how I view all this with the Federal Reserve, and this is one I used at one of the cocktail hours at the conference or board meeting I attended, and you might not like it, but I like it, and so I'm going to share it with you now, Sam. I kind of view what's going on with the Federal Reserve right now, and imagine an emaciated person. A supermodel or something like that, comes in very thin, looks very, very hungry. You give that person a milkshake, right?
Okay.
And you keep on giving them milkshakes because it worked the first time. They start putting on a little bit of weight. So here you are, you keep giving them milkshakes because it's good for them. And then all of a sudden they get to the point where they go from a size 0 or 2, and then they're wearing circus tents, and you keep on giving them a milkshake because it helped them out previously, and you keep on doing it. And I said, that's kind of what the Federal Reserve has done.
Yeah.
They keep on giving us milkshakes long after the point where we actually need milkshakes any longer. However, you take those milkshakes away, all of a sudden that server doesn't get paid, and all of a sudden that dairy farmer doesn't sell their milk, and the person that makes the ice cream, they get upset. So they're all screaming, keep on giving the big guy, keep on giving him the milkshake, and it worked a little bit better after a couple of cocktails. But I think you get the point.
Yeah, and it's hard to stop. And
it's hard to stop.
And it kind of reminds me of that quote. What is it exactly? I'm going to butcher it, but they say the market can remain a lot more irrational longer than you can remain in the market, or something like that. Basically, I mean, basically these things can go on a lot longer than people think they will, and these trends don't necessarily revert to a mean just right when they should, or when the market is flush with cash. And I think it's going to be a while. I think the Fed's going to continue this, and I think they're going to continue to find a reason to support the economy and probably push off rate hikes even longer than the current market expectations. And I just think there's always going to be something.
Well, I think that they've boxed themselves in a corner. It doesn't sound like we're trading too many perspectives. Kind of box themselves into a little bit of a corner. And when they change monetary policy, I think they're going to have to telegraph it so far in advance that it doesn't come as any sort of surprise or any sort of shock whatsoever. I mean, I think if and when they ultimately decide to taper, they're going to say, we're going to start doing this at the end of the second quarter of next year or something along those lines, so the market can have a momentary freak out, but then start planning for it. If they try to give it to us with some sort of shocking announcement in an implementation minutes from a meeting, I think that's going to cause much more problems than if the Fed just simply treats it as a fait accompli and lets us know well in advance.
And I think that's what they're going to do. I think they've really done a better job this time around, forecasting what they're going to do. And, we joked about the term talking about tapering.
Yeah.
And Jay Powell even mentioned that in one of his speeches recently in recapping one of the Fed meetings, is that they talked about when they're going to start talking about tapering. And so I think they're doing their best in terms of giving the market as much of a runway as possible to get to that point.
Well, fair enough. The Federal Reserve's been doing this for a while. They're probably going to continue doing it for a little while longer. And if and when they ever quit, they'd better be pretty transparent about it.
That's right.
All right. Well, guys, thank you so much for listening. We always love to hear from you. Also, if you have any comments or questions, please, by all means, drop us a line. You can always reach us at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you want to read more or listen to more of what we have to say or how we think, please go to oakworth.com and take a look underneath the Thought Leadership tab, where you can find all kinds of awesome information. Sam, you have any more thoughts about the Federal Reserve here today?
That's all I got.
That's all I've got today, too. Y'all take care.